What's up, guys? It's Munch again. Today I'm going to talk to you guys about options. I really like options because I feel like the price action moves a lot more than just trading stocks. Buying and selling and waiting for that 5% change, that 10% change, I feel like it just doesn't happen as often as options. In the options of a stock, you see it had a low of 12 cents and high of 31 cents. So easily 100% difference in a day. And you don't see that really on a normal buying and selling of shares. So what is an option? What is a contract? So if we look at this trade, let me go to GDX. GDX is a gold company. They have gold and a lot of their price action is reflected based on the price of actual gold. So when I go to trade tab, it's going to show me this option chain right here, option chain, and it's a list. Now, an option contract is a document saying, and these are people buying and selling it. It says you have the right to use this contract and give you 100 shares at this strike price. That's what a strike price is. So the current price of the company is $38.52. However, this contract will give you the right to buy it at $35.50. And that's just all part of the contract. It lets you do that. Now, there's two ways to use a contract. You can buy the contract and actually exercise it, or you can just buy it and wait for the value of the contract to go up and then sell it to somebody else. You don't have to use it. So I'll give you an example of both. So right now let me get some more, show some more. All right. So the call to strike prices, they go really low and really high. And that's just based on what you predict the stock's going to do. So like right here, when it was at low of 37, I'm going to be bullish. So there's calls and puts. Calls are being bullish, puts are being bearish. So it's at $37. I'm like, hey, I think the stock's going to do really well. The price of gold is doing strongly right now, so I think it's going to go up. So I want to get this $39 strike price. No, let me do the other example first. I'm going to buy this $30 strike price. And it's going to give me one contract will give you 100 shares if you exercise it. So you're going to pay $8.55 for each share, and it's an automatic 100. No negotiating it, automatic 100, so that you're actually going to pay $855 for the 100. You buy the one contract, you exercise it with your brokerage, they're going to give you 100 shares of GDX at $30. Now, you paid for the contract, you're also going to have to pay for the price of the stock. So 100 of this, you're going to pay $3,000 for those 100 shares. So you're going to have to pay $855 for the contract and $3,000 for the actual stock. So in total, $3,855 just to get 100 shares at $30. Now, the way you make profits, though, is the difference in the price of the share. So $30, what you started at, it's already at $37 over here. So that $7 difference, whatever that increase may be, 4%, you're already catching up a little bit of your loss, that $3,855 that you paid. And the only way to make a profit essentially was when it goes up to $39, $40, $50, then you would be in the money, they say, and you would make a little bit profit. But the better way to use options and to make more profit is just buying and selling them back to other people. So I'm gonna give you an example. I'm gonna look at the price. I'm gonna throw the price action on this contract on a chart. So set it to red, and now we're gonna take a look at the chart. So they got these different studies, and then you can add and subtract indicators as you want. This one always just pops up for some reason, open interest. All right. So now we're actually comparing the actual price of the stock and the normal share price, GDX, and its option contract price. So for today, the contract price represented with these candlesticks, the contract price was at 12 cents for one, or $12 for one, sorry. $12 for one contract. It eventually went up to $30, $31 for one contract. Now I don't know what percent is, but it's easily 100%. Easily double your money if you just would have waited a little bit. And that's just in the different 16, so about 1700 to 2100. So that like 5 hour difference, you would have doubled your money. $1,000 would have turned into, 2,200 or something. And so we can see that the price of the option contract similarly reflects the price of the actual share price. So we see on the left side, we got our $37.60 range, and the price of it was at 12 cents. And then when it went up here to $38.47, the price went up to about 32 cents. And that's huge difference. That's 100% gains versus in the other tactic, you're really making only 5-7% profits maximum. But this, I know it doesn't seem like a lot, but it's really double your money. The only thing with this company though is that it's not a lot of volume. Look, they sold 27 contracts. You want something like Tesla. Tesla would have a lot of people buying and selling option contracts. Trade. Where did they put my order book? No. There it is, option chain. That's weird. So yeah, they would have had a lot more volume in these charts. All these different price points. But it's really the key difference in the chart. Really that just a minute amount of increase, perhaps from this, or this is the actual one, right? No. Comparison line, yeah. This is the actual price of Tesla. From 774 to 750. Let's see what the options price did. 774 to 750. So we need to look at a lower strike price. So I wouldn't have known that it was going to drop so much so fast. But that's a huge difference. In the options contract world, if they call it points, moving down several points. 774 to 750 is 24 points down. And so if I was bearish on it, I'm like, it just hit a high and it couldn't break its previous high of the day, double topped, touched right here, touched right here. That's a double top. That's a bearish pattern. It couldn't break the resistance. People realize this, it's going to go down. So we look at, I'm saying it's bearish. It's at 770. So I say maybe it's going to go to 760. So it's $1,590 for one contract. One put option. So we throw it on the chart. We see how it did. And let's add the comparison with the actual Tesla price. And you're going to find it's quite intriguing. It's the exact opposite. That theoretical, I don't know what says it. It's the exact opposite for puts. So right here, the stock, when it was 770 and it started tanking. When the stock goes down, the put goes up. That's because you're betting that it's going to go down. Calls you're bullish, puts you're bearish. And whenever you're right, you're going to see that in the reflection of the price. So when it was hitting its new high right here, 777 we got, it was at a low of $750. Tanked right here. Price went all the way up to $1,981. So easily 100% gainer right there. In the actual share price, it was only a change in $20. That's like 2-3%. But in the contract world, that's like 120%. And now you see why I really prefer to do options trading. That's why Bell does options trading. There's more money in it. There's faster volatility in the price, because trading of contracts, it doesn't matter what the actual price of Tesla is doing. If people are bidding, $1,000 for the price, they're just bidding $1,000. It's an open auction. People are going to offer whatever they want. People are going to buy whatever they're selling it for. Doesn't matter the price of the chart. Now, the price of the chart does influence how much people are going to bid and auction. So I would definitely check out options trading. Definitely try to make a put option, a call option, where you see the indicators, support and resistance levels, and try it out. Buy like one option and see if you can make some decent profit. I'll see you in the next video, guys.